Hello all, it's Burton here. Just wanted to jump on and show you guys something. I was just talking with my brother this morning and we were talking about supply and demand and how important supply and demand is. And obviously this is one of Wyckoff's 3 laws, which you can see on the screen here. So the law of supply and demand determines the price direction. So this is very important because supply and demand is essentially supply overpowering demand or demand overpowering supply. This is going to determine whether there's more buyers or more sellers in the market, right? So if we was to look at this, not this one, this chart that I have here, this is literally supply and demand. And this is why we say price delivery is so important as well, because obviously we see price delivery as range, initiation, mitigation, continuation. But this picture here that I've drawn out is exactly the same as this picture on the right. The only difference here is we can see what's left. So obviously here there would obviously be a demand zone, and this is a supply zone. So we know supply and demand to be ranges or candles. Like, I mean, candles is in OBs, for example. So like an FU wick, a full-bodied OB, last buy to sell, so on and so on. These are supply and demand in the market, right? Also ranges. So ranges and candles are both supply and demand in the market. So let's take this picture, for example. We see a sideways range, initiate lower prices, right? This is supply being added to the market here. Supply has been added to the market. This is also demand added to the market. Obviously, we know price delivery needs to be mitigated. So mitigation, continuation. If we don't get any mitigation and we just continue higher, create a new range and then higher prices, this then becomes demand that hasn't been mitigated, right? So we know this. So in this picture, for example, we have supply that's been added to the market in this range. We see supply overpowers demand, so we get that pushed down into the demand zone that hasn't been mitigated yet. So then we see that mitigation. We see reactions, supply and demand as reactions, no follow through, or reactions and follow through. Reactions and follow through means that there was more supply than there is demand. Reaction no follow through means there was enough demand in this area here to push price higher, but not enough to break the supply. So there was more sellers than there was buyers, more buyers than there was sellers, for example. That's supply and demand. So in this picture, obviously we see supply added to the market. We see a range, initiation of lower prices, obviously first part of price delivery. Then we look back into the range and we see that this whole range is supply. Obviously we could look deeper into this range and see the last buy to sell and so on and find our exact point. And that's obviously what we do for our precision. But just taking into account Wyckoff's supply and demand laws only on this video, we're seeing here that this range caused lower prices. So supply overpowered demand. We went back into a demand range, or OB, either candle or range, and we've mitigated out here. But this, where we say reaction no follow through, meaning this reaction didn't cause a break of this swing structure, so that there was not enough demand to overpower this supply. So not enough buyers to overpower the sellers. Essentially, it's quite simple understanding of this, but essentially that's what's happening, and that's what's happening over and over again. So for example, if the momentum's bearish, obviously it just means supply is overpowering demands. Now these become what we call reaction points. Unmitigated ranges, unmitigated OBs become reaction points, right? And these reaction points then create more liquidity. But if that liquidity doesn't, if this reaction from this demand zone doesn't go on to create anything, doesn't take out the swing high, we know this to now be a weak low. And that's how we understood weak lows, that demand was not enough to overpower supply, so that the supply will continue to push lower, the sellers will continue to push price lower. And essentially that's exactly what's happening in this picture here. We're always reacting off a range of some sort. So whether that's a supply or a demand range, we're always reacting off one of the two. Now that reaction is determined of supply and demand is now determined from whether that reaction causes a follow through or it doesn't cause a follow through. And obviously we know that to be weak lows and strong highs, etc. But in this picture here, we obviously got range, initiation, lower prices. We mitigate out of that supply range. Enough supply was then distributed to push price lower. And that's why you see price pushing lower. So in the opposite example here, demand's added to the market, push price higher, right? There was enough demand in the market to push price higher. And that's why we never came back, right? There's more demand than supply. Demand has overpowered supply. But now when momentum shifted, let's say this is a momentum shift that we've had here for lower prices, and this becomes a supply zone. Let's say, for example, this is a higher time frame supply zone that prices reacted from, right? So supply is overpowering demand now. We push price lower, more supply being added to the market, push price lower, right? Straight into our demand zone. Now, this demand, there's not enough buyers here to push price higher. And that's why we see price push a little bit higher to mitigate out of this supply zone. Then now there's more sellers than there is buyers at this point in the market, which then push price lower. And obviously we see that as weak close. Sorry if I'm repeating myself. It's just I'm trying to explain it in different ways so that people can understand in different ways. But that's essentially what's happening. So this whole law of supply and demand, when demand is greater than supply, price rises, and when supply is greater than demand, price falls. This is literally, it's very, very simple, but the understanding is just, our understanding is just reaction, no follow through, creating a weak low, or reaction and follow through, creating a strong high. And essentially then this will be a new range, creating more supply in the market, because at this point there was more supply than there was demand. So then we get a new range that obviously creates that strong high. So obviously strong high, price never broke, new strong high, being more supply added to the market. So now let's say, for example, price moves down here and we get a momentum shift bullish, right? So let's say there's a higher time frame point of interest that we've got down here with demand being added to the market, and that shifted momentum bullish, right? So now the momentum is bullish. There's more demand, there's more buyers than there is sellers in the market. So now these points here now become what we could call your, as WWA calls them, your decision points, because essentially when price comes back into this supply zone, is there going to be more supply in the market here than there is demand? Now we see that as sorry, let's just clear this up. Let's go forward one. Cool. So we've come back into supply from demand. So there's more buyers than there is sellers. Now, once we get back into supply, because the momentum's bullish, higher lows, higher lows, higher lows, right? Structure's bullish, and we've reacted off a higher time frame point of interest. Now, this point here is a point of supply, right? We've understood that because we've followed the mitigations. But momentum has shifted bullish down here, which means there's more buyers in the market. So now this point here is determined whether is this supply going to create a momentum shift? So there's going to be more sellers than there is buyers in the market, or is this going to become reaction, no follow through, back into the previous demand, right? Buyers over sellers. Then this reaction here doesn't create any follow through, meaning weak high, and all the liquidity that's created here is also to push price higher. And that's essentially just demand overpowering supply, or supply overpowering demand. And it's literally just as simple as that. There's no need to overcomplicate it, but it's a very important law because it's one of Wyckoff's 3 laws. And supply and demand determines the price direction, essentially. And that's literally just what we're seeing here. So our only understanding now is to just, does this reaction from this supply or demand zone, which we know to be either a range or a candle or a series of candles, a series of sells to buy or a series of buys to sells, does that reaction cause a follow through or does it not? And that's the only thing we really need to understand when we've identified our supply and demand points, because knowing that this reaction here didn't cause a follow through, we didn't get a momentum shift, means that the momentum's still bullish. So we're only still buying. And that's just very, very important in terms of understanding direction. So we can do this on any time frame, whether it's the minute, the hour, the 4 hour, the 3 hour, the 2 hour, the 30 minute, 15 minute, it doesn't matter, because we're able to identify price delivery being range, initiation, mitigation, continuation, and price is always going to be reacting off a range or a series of candles, or a OB as we understand it as. And essentially that's just a range, a sell to buy, reacted here, no follow through, then we react here, there's more sellers than there is buyers, supply overpowers demand, and we continue lower. And that's literally as it's and I keep repeating myself, but it's the simplicity of understanding supply and demand and reactions and no follow throughs that's going to really determine direction. And that's how you obviously understand direction. So if any of you are taking multiple losses in a row, for example, all it means is you're just on the wrong side of the momentum, or you've entered within the middle of a price range. So for example, let's say we get a range here, we get initiation of higher prices, we react off supply pushes price lower, and you've entered the market middle of the range here, for example. Let's say there might be a smaller range here, initiation, and then that mitigation pushes price higher, which means there wasn't enough demand here. Price pushes back lower. We get the real demand, which is that the origin of this move, reaction, follow through, and essentially that's all it is. It's just understanding where you are taking your trade. Are you taking a trade at the edge? Obviously, the edge being the low in this example here, or are you taking your trade in the middle of the range? And that's literally just there's two reasons why you're going to lose, and the first reason is you're taking it in the middle of the range, and the second reason is you're on the wrong side of the momentum, meaning that there's more demand in the market as you're selling, or there's more supply in the market as you're buying, and obviously then you'll just get taken out. But yeah, I just wanted to jump on and do a quick video of this just to describe it, because I was talking about this with my brother this morning, and obviously this is literally what me and Chucks do as well. We'll sit here and just and go through understanding, and this is how you develop your understanding and push further logic and understanding into what you already know. So yeah, guys, just wanted to do that quick video, and catch you all later.